Howdy, Jacob here. Again, Merry Christmas Eve to everyone who celebrates. Hope everyone is enjoying some hopefully well deserved time off. Today's company we'll be looking at is Invesco. Sure, maybe a few people have heard of it. This is the QQQ is run by Invesco. If you've all seen any of those advertisements, it's Invesco QQQ, innovation, whatever. So that's what we'll be looking at today, a 9.4% dividend yield. That is huge. That is huge. It's in the capital markets industry, about a $7.7 billion market cap, $14.6 billion enterprise value. So it appears to be a good amount of net debt on the company. Price to book of zero point 0.5 looks pretty cheap right now. PE of 9.2 looks pretty cheap. Thing that kind of surprised me, if it does what I think it does, invest for, looks like it provides services to retail clients, institutional clients, high net worth clients, whatever. I'd assume that, the growth rate would be pretty in line with kind of what the market's been doing. And it looks like it's been quite a bit lower for how well of a decade the 2010s was in terms of investments. And so you'll see about 4.6 billion on revenue in 2013 to about 6 billion in 2022. That's less growth than I would have thought. Return on invested capital, nothing to brag home to your parents about. Let's look at that net debt here. So 5 billion in net debt, or 5 billion long-term debt in 2012. We're seeing about 8.1 billion in 2022. Okay. 480 million capital leases. Only 1.4 million cash on hand. This will be a company I really hope that they make some solid free cash flow. So about 8 billion in long-term debt and maybe 5-year average of something like 800 million. Let's see, we got 500 million, a billion, 1.1 billion, a billion, 700 million. Okay, so what I can say though, as for dividends, their payout's about 590 million, and like I said, their 5-year average, let's say, is roughly 800 million. So the thing I don't necessarily like, well, I don't like at all, is that their long-term debt is roughly 10 times their 5-year average free cash flow, and their dividend payout of roughly 600 million is a 75% payout. And it looks like to help fund their dividend along with these other investments and buying back of shares, they've been going into debt. So it's definitely, there's going to become a time where they're going to be more focused on paying down this debt, and I think that will dampen their dividend a little bit. I think as of right now, all else equal, if they're able to refinance their debt and everything, I don't think it'll affect them too much. If we're looking at a 2% increase on their interest rate debt of $8 billion, we're looking at about 160 million. That's definitely an impact here on the 800 billion average or $800 million average 5-year cash flow. That'll drop that down to a little over 600. But it's really just the lenders being confident whether they can pay that back or not, or whether they're going to be wanting their money back. And so to me, I'm going to be a bit conservative here because of all the debt that they have. Although I said that they can fund their dividend right now, I think with interest rates jumping and with them using their excess free cash flow to want to buy back shares, make investments, I think just cutting that in half is probably the responsible thing to do. We'll still have a nearly 4.7% dividend yield. It's still well above the market and matches what we're looking for here of a dividend yield greater than 4%. But for me, I think if they cut that in half, their dividend payout would be just under 300 million, and I'd be more comfortable with that. Again, given the fact that they want to use money to buy back shares, make investments, and hopefully start buying down some of that debt soon when interest rates, when they refinance their interest rates at a bit higher level. So let's start making some other assumptions here. Let's look at revenue growth. So like I said, I thought it'd be more in line with what the market did, and it lagged kind of a little bit. So to me, if I think that there might be some turmoil in the next couple years, looks like they've historically not grown as much as the market. So to me, I think it might lag quite a bit. I don't even know if it's going to grow with inflation. I might do. If we look at the last 4 years, they really haven't grown at all. They haven't made any acquisitions either. Maybe if they make acquisitions, they'll grow at 2%. But the business itself, probably not really much growth in the business. And maybe after 7 years, there's little growth. So for me, I think a 10p is probably fine. I don't see a reason to bump it up without looking without doing a deeper dive. But for me right now, I think my initial assumptions are pretty fair. 17 average there, 15 average there. I'm going to bump it down again because they have quite a bit of debt and their interest expense is probably going to jump a bit more than what it's been historically. But maybe I'll do 15 and 13, something like that. That seems maybe 15 and 14, just a percent, because I still want to look at the company possibly. Um, let's assume zero growth. Let's assume they buy back 0.5% of shares a year for the next 7 years, because it looks like pretty big jumps 2019 to 2020. Recently, they've been buying back some more shares, but over a 7 year average, let's say it's that. Then we get to a price where it needs to fall another 42% to get to a 15% return given these assumptions. I think overview, it definitely matches the screener over 4%, even if they cut it in half. But I really want the company to cut the dividend in half so they can start focusing on some of the other things they want to do. As again, I think as interest rates rise, the market may lag. I think the Invesco might slow down a little bit, and so the payout will be a higher percentage than what it is currently looking like right now. And again, they've been funding a lot of their excess free cash flow, or what they've been doing with their excess free cash flow has been greater than their free cash flow. So they've been going into debt pretty consistently from 2013 to 2021. Whereas they should be thinking about paying down some of this debt and thinking about other things to do with their free cash flow instead of just keep going into debt, because that can get ugly, as we've seen with some stocks recently. So hope everyone has a good holiday time with their family, hopefully, and if not, are still enjoying everything and good time away from work. So thanks and have a good rest.